Hello. Today we are going to break down the latest earnings from two of the biggest names in tech, Meta and Microsoft. And we're going to look at it all through one single lens, the absolutely massive costs of building the future of artificial intelligence.
All right, so let's get right into it because it's a bit of a puzzle. You see, both of these companies delivered really strong results. But the market, well, it cheered for one and it really questioned the other. So the big question is, why? It all boils down to how they're spending on AI and maybe more importantly, how Wall Street perceives the return on that massive investment. It's clear the market is looking for very different things from each of these giants.
Okay, before we go any further, just the usual quick disclaimer. This is my own analysis, and it's for educational purposes only. It is definitely not investment advice. Any numbers or figures we talk about today are just for context. They are absolutely not guarantees of any kind of future performance or growth.
So here's how we're going to break this down. First, we'll tackle Meta. You'll see their revenue is roaring, but their costs are soaring right alongside it. Then we'll switch gears to Microsoft, where their future bookings are booming, but some doubts are looming about just how much they're spending. After that, we'll do a deep dive, a head-to-head on their AI capital strategies. And finally, we'll wrap it all up with the key takeaways.
All right, first up, Meta. And really, this is the story of an absolutely incredible quarter for their main business that was almost completely overshadowed by just how much money they're spending. Just look at this top-line number. Revenue growing 24% year over year. I mean, that is just phenomenal for a company of Meta's size. Let's put that in perspective for a second. This isn't some small startup. We're talking about a company that's already massive. So growth like this, it tells you one thing very clearly. Their core advertising engine isn't just healthy, it is absolutely firing on all cylinders.
And when you peel back the onion a bit, the picture gets even better. So they're showing 18% more ads, right? But at the same time, they're charging 6% more for each of those ads. That right there is a powerful 1-2 punch. And you have to understand, this is a direct result of their AI investments paying off. Better engagement, better ad targeting. And what did that do? It blew past earnings expectations and gave them the confidence to issue really strong guidance for the next quarter.
But, and this is a huge but, there's the other side of the coin, $6 billion. That's the record quarterly loss from their Reality Labs division, the metaverse bet. We're talking about a business unit that is just burning cash. That's a staggering number in a single quarter, and it's a big reason why Wall Street is so laser-focused on the cost side of this story.
So here's the tension in the story, right? The core ad business is booming, no question. But the spending on the future on AI infrastructure, it's growing even faster. Think about it, operating expenses shot up 40%. That's way ahead of the 24% revenue growth. And then they dropped their guidance for future spending, which came in much higher than anyone expected. And that, you can imagine, sent a bit of a shockwave through the market.
So, what would have made this a perfect 10 out of 10 report? Well, it was almost there. But to get that perfect score, you would have needed to see that incredible revenue growth matched with let's say, a more contained outlook on future spending. That would have just erased any lingering doubt.
But you have to give management credit. They knew this was the big concern, and they addressed it head-on. They gave this one crucial piece of guidance, basically saying, look, despite this huge step up in spending, we still expect our operating income in 2026 to be higher than 2025. And that was the exact signal the market was desperate to hear. It was a promise that, yes, there is a positive return on all this capital coming down the line.
Okay, let's pivot now and talk about Microsoft. And you're going to see a similar story here, really strong performance, but a completely different set of questions from investors. The headline for Microsoft is all about a boom in future contracts, but that's happening against a backdrop of just, rapidly rising spending.
So from a 30,000-foot view, the results were just plain excellent. Revenue beat expectations, earnings per share beat expectations, and it was all driven once again by that powerhouse segment, the intelligent cloud. I mean, the Microsoft Cloud business as a whole crossed $50 billion in revenue in a single quarter for the very first time. Just incredible.
And the number everyone was watching, of course, was Azure growth. It came in at a blistering 39% year over year. Now, not only was that ahead of their own guidance, it was way ahead of what the street was looking for. This just screams one thing: powerful, continuing demand for their cloud and AI services.
You just can't deny the momentum here. The business is performing exceptionally well. In fact, management basically said the demand for their AI services is so strong, they're running out of space. It's like having the most popular restaurant in town. There's a line out the door, and you just can't build tables fast enough to seat everyone who wants to get in.
Now this number,
This number is just wild. It's what's called the remaining performance obligation, or RPO. And what that means, in simple terms, is future revenue that's already locked in under contract. It's their business backlog. It's a huge indicator of future growth.
So when you look closer at that RPO number, it grew an astonishing 110% year over year. Now look, a big chunk of that is from a huge deal with OpenAI, that's true. But even if you take that out of the equation entirely, the core backlog from all their other customers still grew at a very, very healthy 28%. So this isn't a one-trick pony, it's showing real broad-based strength.
But here again we see the flip side. All that incredible demand, well, you have to spend a ton of money to meet it. And their capital expenditures aren't just high, they're accelerating. Just look at the trend on this chart. Quarter after quarter, it's going up. This is the price tag for building the AI future, and believe me, it is a very hefty bill.
And this brings us to the core question that investors started asking. It's a pretty simple one, really. If you're spending money this fast, at an accelerating rate, why isn't the Azure revenue growth rate also re-accelerating? Look, 39% growth is fantastic, nobody's denying that. But the market wanted to see that surge in spending translate into even faster growth right now.
So again, what would have made this a perfect 10 report for Microsoft? Well, in the market size, you would have needed to see that incredible backlog growth paired with a clear signal that it was translating into faster Azure growth today. That would have been the knockout punch, directly linking spending to immediate returns and erasing any of these questions about ROI.
Okay, so this really brings us to the heart of the matter for both companies. How should we, as analysts, think about this colossal capital spending? It really is the central question if you want to understand where these two are headed. Because when you put them side by side, you see two very different philosophies for monetizing AI. For Meta, think of it like a direct pipeline. They spend money on AI, that AI makes their ads better, and that flows directly and almost immediately into their revenue. The ROI is right there, clear as day. Microsoft, on the other hand, it's more like a broad ecosystem play. The investment fuels Azure, yes, but it also fuels their whole suite of Copilot products. The ROI is spread out, de-risked across many different areas. And this is a really crucial point to get. Microsoft's CapEx isn't just for serving other companies on Azure. Management was very clear about the pecking order. First dibs on all that new capacity goes to their own high-margin products, like the Copilots. Then it goes to internal R&D, and only what's left over is sold to the public on Azure. So that helps explain why you're not seeing Azure growth itself re-accelerate. They're eating their own cooking first, so to speak.
And this right here, this is the quote that really resolves the market's main concern. Management basically said that a majority of the capital they're spending, all those expensive GPUs they're buying, are already contracted out for most of their useful life. Think about that. The risk is massively reduced because the capacity is effectively pre-sold. The return on that investment is largely locked in before they even turn the servers on.
Okay, so let's wrap this all up. What are the final takeaways from this deep dive into the AI arms race?
So here's the bottom line. From Meta, the market walked away feeling comfortable because the return on their AI spending is tangible. You can see it right there in their core advertising business. For Microsoft, the story was a bit different. They made the case that their massive investments are largely de-risked thanks to that huge backlog in those long-term contracts. And the big theme connecting both? We are in an AI investment cycle like nothing we have ever seen before, and understanding the return on that capital is really the only thing that matters.
And that leaves us with one final big question to think about. As this AI arms race just continues to intensify, and trust me, it will, which of these two capital strategies is going to deliver better long-term returns? Is it the direct, focused approach from Meta, or is it the broad ecosystem platform play from Microsoft? That, I think, is the central question we'll all be watching for years to come.